What if the very safety net you spent decades weaving begins to fray just when you need it most? You've dutifully contributed to your pension, watched the statements grow, and breathed a sigh of relief when the day finally came to trade commute stress for morning coffee on the porch. But what no one tells you is that pensions were built for shorter retirements. Think 15 or 20 years, not the 30, 35, even 40 years many people are living today. That means there's a real chance your pension could run dry long before you do, leaving you scrambling for income when health costs spike, inflation eats away at every dollar, or an unexpected market wobble forces you to tighten your belt. It's a scenario that feels impossible when you're opening those monthly checks, but it's one that becomes all too real when you're 80, 85, or beyond, and those checks buy less than they used to, or worse, stop altogether. And here's the kicker: you won't see it coming on your balance sheet. There's no glaring at risk warning in your account summary, no flashing alert when your cushion is thinning. Instead, the erosion happens quietly year after year until one day you wake up and realize that the lifestyle you planned for travel, hobbies, security has slipped out of reach. Even worse, by the time you sense the shortfall, options are limited. You can't rewind the clock and sock away more money, and most retirees feel too worn down to reinvent income streams from scratch. So before you assume your pension will carry you through, it's crucial to face a hard truth. Living longer than you outlast your pension isn't just a financial miscalculation, it's a retirement crisis nobody budgets for, and one that could redefine everything you thought you knew about your golden years. At 65, the average retiree might expect to live another 19 years into their mid-80s, and that's just the midpoint of the curve. Half of 65-year-olds will live past 85, and an ever-growing share will make it to 90 or beyond, Jackson Wikipedia. Yet, most pension plans were designed assuming payouts of 15 or 20 years, not 30 plus. That mismatch creates the first and most fundamental risk of retirement: longevity risk. It's the danger that your money simply won't outlast your lifespan, leaving you scrambling for income in the final decades of your life. This isn't theory, it's playing out right now as life expectancy gains continue to outpace planning assumptions. Pension funds and annuity providers are scrambling to adjust, but as an individual retiree, you're on your own if you underestimate how long you'll live. Imagine counting on those monthly checks, only to find them stretched thinner each year as the same fixed sum must cover more weeks, months, and years than ever before. You can't rewind the clock and top up your plan once you realize you're going to live longer than expected, and most people don't even consider this until it's too late. When your income stops matching your needs, you face stark choices. Cut essentials, liquidate assets at a loss, or rely on family or social safety nets that may not be there. Longevity risk quietly sabotages your retirement if you don't confront it head-on, and yet it's almost never factored into the glossy brochures or standard financial plans that promise you'll be secure once you retire. Even a modest, steady rise in prices can quietly drain the value of your pension faster than you realize. Imagine an inflation rate of just 3% per year. By the time 23 years have passed, the purchasing power of a fixed pension check is cut in half, meaning today's comfortable lifestyle could cost twice as much in the decades ahead. Yet, many defined benefit plans lack robust cost of living protections. Some offer no automatic adjustments at all, while others cap increases or apply only partial indexing. For example, certain public service plans grant just 60% of the annual inflation rate. So, even though you see a bump on paper, your real buying power still slides backward. Public Service Pension Plan, triaf.mb.ca. What's worse, retirees often don't notice the slow erosion until it's become severe. Groceries subtly cost more, utility bills creep up and healthcare premiums rise, all eating into a check that feels like it should be enough. And once inflation has chipped away at your pension's value, there's no way to claw it back. You can't revisit past contributions or demand retroactive raises. Over decades, that lost purchasing power translates into fewer social outings, skipped medical appointments, or cutting essentials just to make ends meet. All the while, you might still be checking off your statement thinking you're covered, unaware that reality is slipping through the fine print of your plan's adjustment formula. In an era when retirees commonly live 30 years or more beyond retirement age, failing to account for inflation erosion is like signing up for a race with a head start against yourself. You may be financially solvent on paper, but in practical terms, each unindexed dollar becomes weaker over time, leaving you vulnerable when you need that income most. By the time you reach your late 70s, healthcare can turn into a silent retirement killer all on its own. You might assume Medicare has your back, but the reality is far more complex and expensive than most retirees realize. A recent Fidelity study found that the average 65-year-old couple will spend roughly $157,500 on healthcare over their retirement years, Fidelity Newsroom. That number hides a harsher truth. Costs don't spread evenly. Between ages 65 and 74, you might spend about $13,000 a year. From 75 to 84, that jumps to $23,000 annually, and after 85, you could be paying closer to $40,000 each year, RBC Wealth Management. Those figures include premiums, deductibles, co-payments, and routine care, but they rarely cover long-term care, home health aides, or unexpected procedures. Most retirees scramble when they get that first bill for a home nurse or rehab stay, assuming their pension checks will absorb it. They don't. Out-of-pocket expenses for long-term care can skyrocket above $100,000 a year, and few plans fully cover it. National Institute on Aging Kiplinger. Worse, Medicare has no cap on annual hospital and skilled nursing facility coinsurance, meaning a prolonged stay can wipe out your cushion in weeks. National Council on Aging. What starts as a few extra copays or a higher premium becomes a slow erosion of financial security. And it's not just about money on paper. The stress of battling bills and navigating insurance denials takes a real toll on your health, increasing your risk of depression, heart problems, and cognitive decline. By the time you realize how much healthcare can devour your pension, you've already been paying for years without noticing, and your options for recourse are almost gone. Sequence of returns risk may sound technical, but its impact can be devastating and often shows up only after the damage is done. Imagine you retire with a comfortable nest egg and plan to withdraw, say, 4% each year. If the market tumbles in your first few years, let's say a 15% loss in year one followed by modest gains, your withdrawals come off a smaller and shrinking base. Even a rebound can't fully undo that early hit. In fact, researchers have found that negative returns in the first 5 years of retirement can slash the longevity of your portfolio by more than 20% compared with someone who enjoys a bull market during the same period. It's not about average returns over decades, it's about timing. A down market when you're still taking money out is far more harmful than the identical loss if it occurred later, when your portfolio has had more time to grow again. The result? You could run out of income years or even decades ahead of schedule, all because of bad luck in those critical early years. Most retirees don't even know to worry about it. Their financial plans show them a safe withdrawal rate under historical averages, but they rarely stress test for the worst-case sequence. And once you're in retirement, you can't pause withdrawals to wait for a recovery. You can't go back and delay Social Security, top up your savings, or extend your career to reset the clock. Taking less early on, keeping a cash buffer, or segmenting assets into buckets for near-dash, mid-dash, and long-term needs can help. But those strategies must be in place before the first downer hits. Otherwise, you risk watching your pension checks erode faster than inflation. Silent erosion that won't leave a red flag in your account statement until you try to write the final checks and they bounce. Even the most stable pension can crumble when the sponsor's balance sheet falters. Across the private and public sectors, underfunded plans are becoming a ticking time bomb. One study found that as many as 40% of multi-employer pensions are less than 70% funded, leaving them vulnerable to benefit cuts under emergency rules, actuary.org. When a plan's assets can't cover promised payouts, the Pension Benefit Guaranty Corporation, PBGC, may step in, but only up to its legal cap. Today, PBGC guarantees a maximum monthly benefit of roughly $1,072.50 for a 65-year-old retiree with 30 years of service. Anyone owed more, then that sees a cut straight away. For example, a Teamster who counted on $3,000 per month could lose 60% of their check once PBGC takes over roll call, and PBGC itself isn't unlimited. It reported a multi-billion-dollar deficit as recently as 2011, forcing Congress to inject billions via the American Rescue Plan. Yet systemic underfunding means future bailouts remain uncertain. Brookings. Corporate bankruptcies add another layer of risk. When a company folds, its pension often becomes an unsecured liability in bankruptcy court. Even defined benefit plans, once seen as rock solid, can be frozen or terminated, leaving retirees navigating legal complexities just to claim what's left. Church-affiliated plans illustrate the danger. Exempt from ERISA oversight, they've collapsed without warning, forcing workers into financial hardship with no recourse through PBGC or federal regulators. Wall Street Journal. The real shock comes when retirees see their checks shrink or vanish, with no refund option. You can't top up an underfunded plan after retirement, and most sponsors won't voluntarily restore benefits once they're cut. That means the guaranteed income you budgeted for can evaporate, sometimes years before you expect it. And by then, options like re-entering the workforce or rebuilding savings are far less realistic. In other words, your pension's security hinges on someone else's financial health, and that's a gamble few retirees realize they're making. Benefit clawbacks and hidden tax traps can turn a supposedly steady pension into a shrinking lifeline without you even noticing. Take Medicare's Income-Related Monthly Adjustment Amount, or IRMA. If your modified adjusted gross income from 2 years ago tops $106,000 as a single filer or $212,000 jointly, you pay surcharges on Part B and D premiums, sometimes adding hundreds of dollars to your annual health care bill. MedicareResources.org NerdWallet. What feels like a bonus from RMDs, required minimum distributions, or a lump sum Social Security back payment can suddenly trigger those higher premiums. Next, Social Security itself can become taxable. If your combined income exceeds $44,000 individual or $32,000 joint, up to 85% of your benefit is subject to federal income tax, slicing deeply into the checks you counted on as untouchable. But it gets worse. Means-tested benefits such as Medicaid, SNAP, or pension supplements can vanish when your income edges above eligibility limits. In many states, even a few dollars of additional RMD income can push you over the Medicaid asset or income thresholds, forcing you to pay full price for long-term care or hospital bills that Medicaid once covered. And if you try to gift assets to qualify, beware the 5-year look-back. Any transfers within that period can delay benefits for months or years. Windfall elimination rules. Imposed when you've paid into both Social Security and a public pension, can cut your benefit formula by thousands annually. Another surprise, clawing back income you believed was secure. These traps hide in fine print and tax tables, so what seems like guaranteed income can evaporate. Careful planning, like timing withdrawals, diversifying account types, or working with a tax-savvy advisor, is your best defense against these stealthy retirement saboteurs. By the time your pension starts to feel like a lifeline rather than a luxury, the emotional fallout can be just as brutal as any financial shortfall. You might expect stress when the checks shrink, but what you don't see coming is how that stress seeps into every corner of your life, your relationships, your sense of worth, even your health. Suddenly, small decisions become overwhelming. Whether to postpone a car repair, skip a night out with friends, or delay a routine checkup. Each compromise feels like one more reminder that your security isn't absolute. That constant internal debate, can I really afford this? Triggers a flood of cortisol and adrenaline, the very hormones that over time undermine immune function, inflate blood pressure, and hasten cognitive decline. Couples find themselves arguing over trivial things, resentments build when one partner still wants to travel and the other worries about every dollar, and kids feel the weight of their parents' silent worries even if no one ever says a word. Social invitations get declined more often. Hobbies that once brought joy now feel like another expense to justify. The ironic twist is that this emotional squeeze can force even the most frugal retirees to make decisions that cost them more in the long run, delaying preventive care, avoiding maintenance on their home or car, or settling for lower quality alternatives that break down faster. Before long, the psychological burden becomes as costly as the financial one. And what happens next will shock you when you realize that your lifestyle and emotional health are just as fragile as your bank balance, making the final lesson far more than a cautionary tale. It's the key to turning your pension into a true safeguard rather than a silent saboteur. Retirement was supposed to be the reward for decades of hard work, yet far too many find themselves living under a quiet threat they never saw coming. The risk that your pension stops before you do. We've seen how simply outliving standard payout periods can leave you scrambling for income in your 80s and 90s, how inflation can stealthily have your spending power, and how skyrocketing healthcare and long-term care costs can devour what you thought was guaranteed. We've looked at the sequence of returns trap that punishes early withdrawals after a market downturn, the reality that underfunded plans and corporate failures can slash benefits overnight, and the hidden clawbacks and tax penalties that quietly claw back income you counted on. We've even uncovered the emotional toll, how the stress of shrinking checks corrodes relationships, health, and daily joy in ways no spreadsheet ever captures. But awareness is power. Now that you know the true scope of the danger, how a fixed check can fracture under the weight of longevity, inflation, and systemic gaps, it's time to act. Start by stress testing your income against longer lifespans and higher expenses. Then explore strategies like partial annuitization, inflation-protected riders, or bucket withdrawal plans to shield against market swings. Examine your pension's cost of living adjustments and consider topping up with side income, whether through consulting, part-time work, or passive streams. Build a healthcare reserve and investigate long-term care insurance before premiums skyrocket. And work with a tax-aware advisor to minimize IRMAA and benefit clawbacks through timing and account diversification. Finally, acknowledge the emotional side. Set a realistic lifestyle budget, foster strong relationships, and seek professional support if the burden feels overwhelming. Because securing your golden years isn't about crossing your fingers and hoping your bank statement holds up. It's about designing a retirement plan that anticipates the risks you can't see on paper and builds in the resilience to keep you safe, well, and thriving for as many decades as you live. Retirement isn't a finish line, it's the beginning of an entirely new journey, one that requires far more than simply punching out and collecting checks. By now, you've seen how each unseen danger, from living longer than traditional payout periods, to the insidious squeeze of inflation, to the tsunami of healthcare and long-term care costs, can quietly erode what you thought was guaranteed. You understand how market timing can turn your savings into a sinking fund, how underfunded pensions and corporate failures can strip away benefits without warning, and how hidden tax surcharges and benefit clawbacks can leave you scrambling when you least expect it. You've even felt the emotional weight of financial uncertainty, the way stress seeps into relationships, health, and day-to-day joy in ways no spreadsheet captures. All of these forces converge into a single stark reality. A pension alone, no matter how generous, can't shield you from the full spectrum of retirement risks. And that's not doom and gloom, it's a wake-up call. Armed with this knowledge, you have the power to reshape your retirement narrative. Stress test your plan against longer lifespans and higher costs. Explore annuities or bucket strategies that marry stability with growth. Build buffers for healthcare surprises and long-term care needs. Work with professionals who can navigate tax rules and clawback traps. And perhaps most importantly, prepare mentally for the emotional ups and downs ahead. Because a truly secure retirement isn't the absence of risk, it's the presence of resilience. It's a plan designed not just to pay out, but to adapt, grow, and protect your well-being for as long as you live. So don't wait until the checks start bouncing to pay attention. Use these insights now to craft a retirement that endures as long as you do, one where freedom, purpose, and peace of mind aren't just promises on paper, but realities you experience every single day.